Beneath the chaos in big tech, a quiet transformation is unfolding, and Dan Ives believes it could change everything. What looks like pressure from regulators and trade wars might actually unlock the next wave of explosive growth, if you know where to look.
I think it's all part of this broader negotiation because big tech has had a bullseye on their back from Brussels and EU for years, right? I mean, fines for big tech are almost like getting a cup of coffee when it comes to what's happening in Europe. But when it comes to AI, look, this is a hardline stance. And I think it's actually all part of even the broader tariff negotiations in terms of them softening the stance. And that's something big tech has obviously been a huge advocate for because essentially Europe's almost off touch. You can't even go into that market right now.
Right now, the markets are standing at a critical fork in the road. After weeks of swirling uncertainty, from looming crackdowns on big tech in Europe to fears of stricter regulations in the United States, investors are hungry for direction. Volatility has shaken even the most confident hands, and the big questions hang heavy. Are we heading into a deeper correction or staring down a once-in-a-decade opportunity? In the middle of all this noise, few voices manage to slice through it with clarity like Dan Ives of Wedbush Securities. In a powerful new interview, Ives offered a take that turns today's fear-driven narrative completely upside down. Sure, he doesn't ignore the real risks, from United States antitrust scrutiny to Europe's aggressive stance against tech giants. But he sees the broader view as overwhelmingly bullish, especially for companies leading the artificial intelligence and cloud charge. Importantly, Ives didn't sugarcoat the situation. Before Tesla's crucial earnings call, he sent up a bold code red warning worried Elon Musk was just too distracted. But after hearing Musk recommit to Tesla's mission, Ives flipped his stance, calling it one of Tesla's most pivotal moments ever. And the optimism doesn't stop there. Ives also points to another potential game changer. A possible Trump administration could ease Europe's hardline approach to AI regulation, which would act as rocket fuel for tech stocks. As he put it, big tech has been treated like a foreign enemy in Europe for years, and a regulatory reset could unlock enormous upside. With this massive shift quietly taking shape, we're diving into 3 powerhouse stocks set to ride the coming wave, leading even in today's chaos and ready to soar when the dust settles. First up, let's talk about a giant that's been quietly tightening its grip on the future, Microsoft Corporation, ticker symbol MSFT. In a market where fear and noise dominate headlines, Microsoft is playing a different game. While others react to every tweet and tariff, Microsoft is methodically locking down its dominance in business AI and cloud computing, 2 battlefields that will define the next decade. Instead of chasing short-term wins, Microsoft is building something that's almost impossible to unseat. Way back in 2019, Microsoft made a bold $13 billion investment in OpenAI, a move many thought was risky at the time. Fast forward to today, that decision looks like pure genius. Thanks to that early partnership, Microsoft's Copilot AI is now baked seamlessly into its Office products, Azure Cloud, and enterprise tools, making AI adoption second nature for businesses everywhere. Despite facing some short-term stock pressure, the company's numbers tell a powerful story. Revenue jumped 12% year over year to nearly $70 billion, and operating income surged 17%. Azure, their cloud juggernaut, is expected to grow another 30% this quarter alone. Here's a wild fact. Microsoft's AI-driven business now pulls in about $13 billion annually, and it's growing at an astonishing 175% year over year. Tariff worries? They barely scratch Microsoft. Unlike hardware-heavy peers, Microsoft's empire is built on digital products and cloud services, making it far less vulnerable to global trade shocks. Add to that a strong dividend, aggressive share buybacks, and a valuation 14% below its 5-year average, and you've got a tech titan not just surviving, but poised to dominate. As Dan Ives said, the winds are shifting, and Microsoft is already sailing full speed ahead. By the way, if you're liking this so far, hit that like and subscribe button. It really supports my channel and helps us keep creating informative content like this. And if gold's ever crossed your mind as an investment, I've got a free guide on gold IRAs linked below. Stick around, I'll go over why it's useful at the end of this video. Now moving on to the next tech titan on our radar. Alphabet Incorporated, ticker symbol GOOG, the company everyone keeps underestimating. While the market keeps trying to write Google off, Alphabet just sent a loud message. We're not going anywhere. In fact, They're evolving faster than ever before. Their latest earnings blew past expectations. Revenue hit $90.2 billion, and earnings per share crushed estimates by a jaw-dropping 40%. Across every segment, from search to cloud to YouTube, Alphabet is not just alive, it's thriving. Here's something crazy. YouTube alone now pulls in more ad revenue each year than Netflix earns from streaming subscriptions. Google search? Still a fortress. YouTube ad revenues are climbing 10%. Google's subscription businesses are growing 19%. And Google Cloud? It's booming, up 28% with expanding margins. Most exciting of all is how deeply AI is woven into their entire ecosystem. Their new AI overviews in search are already being used by 1.5 billion people monthly, proving AI isn't a threat to Google's core. It's a turbocharger. Meanwhile, Gemini, Alphabet's own powerful large language model, is reshaping products like Docs, Sheets, and the entire cloud division. And yet, Alphabet trades at just around 17 times forward earnings, a level that suggests the market still doubts its future. But with huge free cash flows, diversified growth engines, and a strong AI roadmap, Alphabet offers something incredibly rare today: margin of safety and massive upside. As Dan Ives pointed out, with regulatory pressures possibly easing and AI adoption surging, companies like Google are in perfect position to shine once the storm clears. And believe me, the next company might be the most underestimated of all. Rounding out our list is a true heavyweight that's been misunderstood, mispriced, and is now sitting at one of the most attractive valuations we've seen in years. Amazon.com Inc., ticker symbol AMZN. In a market obsessed with short-term headlines, Amazon's recent dip is a classic case of investors missing the forest for the trees. Yes, there have been scary stories about tariffs, recession risks, and data center pauses. But beneath that noise, Amazon is quietly setting itself up for explosive long-term growth. Amazon isn't just the king of e-commerce, it's one of the leading architects of the global AI-driven cloud through AWS. Here's an eye-opener. Amazon's homegrown AI chips, Trainium and Inferentia, are now powering next-gen data centers, cutting costs while boosting performance dramatically. Behind the scenes, Amazon has been busy optimizing its data center footprint and expanding its AI capabilities, moves that position it perfectly for the next stage of tech growth. AWS, the crown jewel, continues to expand margins and boasts a stunning 37% operating margin. Even better, global cloud demand is only accelerating. Meanwhile, Amazon's sheer scale in e-commerce keeps it resilient against tariff shocks that would crush smaller players like Shein and Temu. Despite all this strength, Amazon trades near its lowest valuation multiples in years. That kind of setup, for a company with Amazon's reach and firepower, is extraordinarily rare. With AI transforming industries and cloud computing entering a new golden age, Amazon isn't just ready to survive, it's set to thrive. As Dan Ives hinted, once the dust from today's fears settles, companies like Amazon will be standing taller, stronger, and ready to reward investors in a major way. For those willing to look beyond the panic and focus on the bigger picture, this could very well be remembered as one of the best chances to own a generational company at a deep discount. The stock market's been jittery lately, especially with President Trump's new round of tariffs stirring up global trade tensions. And when uncertainty rises, history shows us where smart money tends to go: gold. Central banks' demand for it last year alone reached a record high, and spot gold just surged past $3,300 an ounce, underscoring its value in the markets. And recently, it has surpassed the Mag 7 as the most crowded trade on Wall Street. If you're thinking about ways to take advantage of gold in your investments, I found a company that gives Americans a free guide on how to add real physical gold to their retirement portfolio in a way that's simple and secure. No sales pitch, no pressure, just honest, helpful information you can trust. Click the link in the description to get your copy now, because when the biggest financial institutions in the world are quietly stockpiling gold, it's not just a trend, it's a signal.